Good afternoon. My name is Ruth McCambridge, and I'm the editor-in-chief of the Nonprofit Quarterly. And I'll introduce our guests in a minute. Today, our webinar is reviewing the landscape of 2018 philanthropy and the kind of significant implications contained in that for nonprofits, and they are significant. I do want to acknowledge that we still have a lot of people entering. So I'm going to hold a couple of pieces for later on as soon as we kind of get everybody on board. We have more than 1,000 people signed up for the webinar today, which is usually the case when we host you, Patrick. So that's a good thing. Today's webinar is being brought to you by Mercer Pavilion. For not-for-profit organizations, it's all about your mission. How do you structure an investment strategy to get you there? How do you balance, that's if you have an investment strategy or if you have money to invest. It's how do you structure an investment strategy to get you there? How do you balance risk and opportunity? What's the best way to maximize returns? At Pavilion, that's our mission. Let's work together to strengthen your conviction in your investment decisions and to achieve your long-term investment goals with confidence. Pavilion, a Mercer practice collaborating with healthcare institutions, endowments, and foundations to help drive better investment income. And I do want to say about all of our sponsors, but today about Mercer, that without them, these webinars would not be able to be brought to you free of charge. And so I hope that every time we read you the name of a sponsor that you note their names down because they're investing in you. And so we want to make sure that you remember them as people who are kind of in your corner. So today is our annual, what's become our annual webinar with Patrick, Dr. Patrick Rooney, about Giving USA. Giving USA is the annual deep dive into the landscape of giving, and this year we're reviewing 2018. And as Patrick said early on, as we were talking about the findings for this year, they are complex. And so there's a lot of moving parts to what's going on this year. There are some larger trends and some factors that need to be weighed in understanding how the dynamics are working. And so Patrick is going to try to walk us through all of that. Some of the trends that we're going to identify today do suggest that nonprofits need to take a particular kind of action. And so, you know, we will talk about that as well. Giving USA is an annual publication of the Giving USA Foundation and is researched and written by the Indiana University Lilly Family School of Philanthropy. Joining us to present the findings will be Dr. Patrick Rooney, Executive Associate. He has a very long title, right, Patrick? Executive Associate Dean for Academic Programs and Professor of Economics and Philanthropic Studies at the Indiana University Lilly Family School of Philanthropy at IUPUI. He is also one of the primary authors of the study and a really nice guy. So thank you for being with us, Patrick. I do want to say to people that we actually are very, very grateful for IUPUI's work in this area, and we track it very closely from year to year. So we're thrilled to have you with us today to take us down into what the findings mean. This webinar will be recorded. The recording will be shared with all attendees shortly after the meeting. We will also make the recording freely available on our website along with the PowerPoint slides to be accessed at any time. And this is an important note. We are going to leave some time for questions at the end of the webinar. So you'll find a questions area towards the right-hand side of your screen. And feel free to start logging your questions now. If Patrick's already answered them, I won't ask them. But if there are any things that you particularly want to have, any questions you particularly want to have answered, we'd love to see them as soon as possible. And that way we can sort through them well and ask Patrick the right set at the end. Finally, we are on social media, so you can follow today's conversation with our hashtag GivingUSA2019. Feel free to post questions or comments during and after our presentation again. And with that, I'm going to hand it over to Patrick, who's going to start us out with just a romp through the figures, right?
Thanks, Ruth. And thanks for having me on this webinar again. And it's always fun for me and hopefully fun for the listeners and didactic for everybody. You were teasing me about my title. So last year at our commencement, one of our former students said, introduced the dean first and said, you know, you can tell the power of a person by the length of their title. So the Pope, very short title. The President, very short title. The Dean. So then I was next and I introduced myself, and after I said my title, well, if the power is inversely related with the length of the title, then I have the least power of anybody in the room. So, and everybody laughed and understood that that was both accurate and appropriate. So let's talk about this year's Giving USA, and let's go to the next slide. Just talk briefly about this history. So the Giving USA Foundation and the Giving Institute have been doing the research and publishing Giving USA since 1956. You know, it's the longest running annual report on all the sources and all the uses of philanthropy. And, you know, this is a very good product in lots of ways. And we try to approach it with a TQM mindset of how do we make it better every year. And so, you know, we appreciate, you know, your suggestions, questions, and input on that. And we have a group of scholars and data wonks from around the country who use philanthropy data, who are on our Research Advisory Council. We also have a number of practitioners from Giving USA Foundation and Giving Institute who serve on the editorial review board, who read the chapters so that they are actually easy to read and factually correct, but easy to understand. So we've been partnering with the Giving USA Foundation to make this product even better each year since 2000 or 2001. So next slide, please. So this slide is probably the key takeaway, and for a lot of reasons. So 2018, you know, the grand total, $428 billion. And this, you know, this is a very complicated year, as Ruth suggested. So there's a number of factors like the growth in GDP and personal income that would suggest growth in giving, but there's also policy changes such as the near doubling of the standard deduction, which we expect would have a negative impact on giving. So we know it's complicated. If you look at the trend line, if you took out 2017 and just look from 2016 to 2018, you'd say 2018 was right on the trend. The oddity here statistically is that 2017 was a record year. 2018 went down slightly in real dollars. It went up a little bit in nominal dollars. So we have the worst of all possible worlds in terms of explaining this, right? So in inflation-adjusted dollars, it's a decline. In nominal dollars, it's a small growth. So it does make it complicated. But it also makes it complicated because this year is the second best year in the history of giving. And so we don't want to make too big of a deal about the fact that it went down, but we also don't want to undermine the effect that total giving did go down. And we're going to go into a little bit of a deeper dive. I think it's important to say from the outset that one size does not fit all, and that we're looking at all of the sources and all of the uses, but that it's unlikely that for any one charity your results look exactly like the results from Giving USA, because many charities rely on different sources of income, and the role of foundation grant making is higher for some and lower for others, and individual giving is higher for some and lower for others. So how you get your returns and how you do your fundraising definitely will affect how much your results parallel the overall results for Giving USA. All right, let's look at the sources in a little more detail. So giving by individuals went down in both nominal dollars and inflation-adjusted dollars, 3.4% decline. And this is important because a 3.4% decline is noteworthy, especially for the most important source of giving. Now, giving didn't plummet like it did during the Great Recession, and so we don't want to be overreactive, but it's also, this is a noteworthy change. When we look at bequest giving, it was flat in nominal dollars and went down adjusted for inflation. One of the things that we know about bequest giving is that it's the most volatile of all the sources of giving, and we know that it bounces around from year to year, and that in fact the top bequest gift that year may change whether or not bequest giving went up or went down. And we know that in every year the top 4 or 5 biggest bequest gifts determine whether or not bequest giving goes up or goes down. When we look at giving by foundations, keeping in mind that foundations are required to pay out 5% of their asset base by law, that it went up 7.3% in nominal dollars and almost 5% in inflation-adjusted dollars. But many foundations pay based off of last year's asset base, but most of them use a 2 or 3 or even 5-year rolling average. And so, the stock market has been growing for almost a decade, and so the accumulated assets have grown, and so it's not a big surprise that even though the stock market declined somewhat at the end of the year, that the growth for the last decade has contributed to a more rapid increase in grant making by foundations. Giving by corporations went up almost 3% in inflation-adjusted dollars, which might be a higher than expected increase given the fact that they faced a pretty dramatic change in their top marginal tax rate as well. But keep in mind that corporations give for a number of reasons, and that taxes play a role statistically, but they're not the main reason corporations are giving. They're giving because they want to be perceived as good corporate social citizens, a member of the community. They want to attract shareholders, attract employees, and attract customers and keep them in. And by being good corporate citizens, that's one of their strategies for doing that. Next slide, please. One of the things that we think had a profound effect in some ways was the tax law, because it had, some factors that would cause increases in giving and some factors that might cause decreases in giving. For example, the increase in the standard deduction reduces the incentive to give. So for example, if you were an itemizer in 2017 and you're in the top marginal tax bracket at 39.6%, it cost you $60 to give $100. If you became a non-itemizer in 2018, now it costs you $100 to give $100. So for most people, a 2/3 increase in the price of a good would cause them to reduce their consumption of that good. And philanthropy is not exactly like all other goods, because there are many reasons people give. And in fact, it would be irrational to give just because of the tax deduction. You'd always be better off if you only cared about yourself, your after-tax well-being. You would never give anything to anyone at any time for any reason. However, Econ 101 tells us that people respond to incentives. And what we see is that the incentive set changed here, and that the dramatic increase in the standard deduction reduces the incentives to give. On the other hand, households were able to expand how much they could give and get a tax deduction for that. In the past, it had been 50% of AGI, and this last year it was 60%. So on the margins, for the people who are giving the highest shares of their income, which are not very many who hit that 50% number, but some do, they can give more and take that tax deduction in that year. Now, we don't think that has a huge effect, both because there's very few people, and in the past, people could carry forward any excesses in any one year for up to 5 years. So we don't think that had a big effect, but it certainly was a positive incentive for giving. Conversely, the cap on the state and local taxes, the SALT deductions, as it's popularly referred to, certainly decreases the likelihood that you're able to itemize your gifts for many individuals. And this depends on a state-by-state, city-by-city basis, but generally those cities or states that had high property taxes or high income taxes would be adversely affected by that. Now, as I mentioned, there were some factors that had a positive and some that had a negative impact. That in the tax policy, we see that with respect to the overall economy as well. So disposable personal income, which is just after-tax income, grew by 5% in 2018, and similarly, GDP grew by over 5% in 2018. The stock market decreased at the end of the year, and so while it grew during most of the year, at year end in late December, many individuals might be making, what I would say a game day decision. So if you're trying to decide whether or not to make a significant allocation to a DAF or to create a DAF, or if you're trying to make a decision to create a family foundation or enhance the investments in your family foundation, and the stock market goes down, you might rationally say, well, let's wait and see what happens to the market and make a decision the following year. Okay, so we had several things going on, so we have the tax law, which, as we discussed, had positive and negatives in terms of the incentives to give, but overall mostly negatives. And the current policy environment creates some uncertainty. So the discussion around tariffs and trade wars and so on. Financial investors, private investors, and philanthropic investors generally don't like uncertainty, and the more uncertainty there is, it tends to stifle investment in plant and equipment in the private sector, but also stifles philanthropic investment in the nonprofit sector. Next slide, please. So this is the classic slide that you've all seen lots of times, and on all the sources of giving. And one of the things that's important to note, and we'll study this in a little bit more detail in a minute, individual giving fell below 70% for the first time in a long time. It's still by far the largest share. It's 68%, $292 billion. So it's the dominant share of all the sources, but it's, it fell last year and some of the other sources grew, so it lost market share. Corporations are steady at 5%, $20 billion. Bequest giving was flat at almost $40 billion. Foundation grant making, as we saw, grew dramatically, and it's a larger share at 18%. And I think one of the things that's important to point out is that of the foundation grant making, about half comes from family foundations. And so if you add in the half of them from the family foundations to the individual giving and the bequest giving, you can see that living individuals, whether through the household checkbook or their family foundation checkbook, and those who have recently passed, are accounting for the vast majority of total giving. Now let's look at the annual and the 2-year combined changes. Total giving 2 years ago grew almost 5%. These are in inflation adjusted dollars, and last year fell by 1.7%. So the 2-year net is 3.1% growth. So again, this last year was a decline, but it's a decline from the highest year ever, and the 2 years combined are the 2 highest years ever. So again, I don't want to over stress this decline, but we need to take note of it. Similarly, for individual giving, 2 years ago, that grew by 3.5%. Last year fell by almost 3.5%. So the net is holding flat. Foundation grant making, run up in the stock market for the last decade. Last 2 years grew almost 15% combined. Bequest giving 2 years ago grew by over 12%. Last year fell by over 2%. Net almost 10%. But you can see the volatility in bequest giving just even in those 2 years. Similarly, corporate giving declined 2 years ago and grew by 2.9%. Some of the corporations, when their top marginal tax rate was announced that it was going to be cut from 35% to 21%, many corporations said, we're going to either make a bonus payment to our employees, but some of them said that they were going to make corporate gifts with what would have been their corporate taxes had they been at the older rate. So it'll be interesting to see whether or not this growth in corporate giving continues at that same pace, or if there's a re-equilibration to the new tax rate as that becomes more standardized. Next slide, please. So earlier I was talking about some individuals and some households making their family philanthropy more structured, more organized. We can see 40 years ago that total household giving was 83% of total giving, and that foundation grant making was 6%. So those two combined were 89%. This last 5 years, household giving averaged 70%, and foundation grant making averaged 16%. So you add those together, that's 86%. So you can see there's a fair amount of stability there between those two amounts combined, but that gifts coming from individuals' household checkbooks has declined fairly precipitously from 83% to 70% over the last 40 years. Next slide, please. All right, where does the money go? Again, $428 billion, 29%, the largest share went to religion. Now, keep in mind that religion used to be 50-55%, and we'll see that in a minute. So while religion fell last year, it has grown over the last 40 years, but the 40-year average is more like 1% per year. And so it's a much slower rate of growth than some of these other subsectors. Education went down, human services went down, gifts to grant-making foundations and health went down, some more than others, and we'll see that in a second, but they all lost a little market share, but keep in mind that those were all coming from record highs the prior year as well. One of the things that's worth noting is the gifts to grant-making foundations is one of the largest subsectors. So, those are gifts that are going into foundations or into community foundations and DAFs, and so that those are permanent commitments to philanthropy. And while many fundraisers might prefer that those dollars come directly into their charities, they are in fact ultimately going to be distributed and granted to charities at the end of the day. Around the corner, healthcare, we got 10%. Public society benefit, PSB, is 7%. This is an amalgamation of a couple of disparate pieces. It includes the commercial DAFs, it includes United Way, includes the federal government's federated campaign, Jewish Federation campaigns, and so on. So that these are united or federated campaigns and the commercial DAFs. So some of those pieces were growing and some were declining, but it gets a fairly large share. Arts, culture, and humanities, 5%. One of the things I think that's the most fascinating, so international is 5%. When we started tracking that in 1987, it was about 1% of total giving. So it has grown very dramatically. Environment and animals, 3%. Environment and animals and international have been the two fastest growing subsectors since Giving USA started tracking those in 1987. So giving to religion has grown at about 1% per year for the last 30 years. International and environment both have been growing at almost 20% per year. So you can see quite a bit of difference. Next slide, please. These are looking at the 2-year changes again, adjusted for inflation, the year by year, and then the 2-year combined in the far right column. So 2 years ago, giving to religion was flat. Last year, it declined by almost 4%. So again, giving to religion is generally it's growing over the longer term, but it's growing at a very slow rate, and we've seen it decline recently. I'm sure many of you saw the research by the Pew organization about the fairly dramatic increase in the number of households that are not affiliated with any mass mosque, synagogue, congregation. And so what we know from our other research is if you're not attending, you're not giving to a religious congregation. And so that might be discouraging news for fundraisers for religious organizations. Giving to education dropped last year by 3.7%, but again, that was following a record increase. Similarly for human services and foundations, so we see the ups and downs of those subsectors. If we go to the next slide, I think this arrays them by the order of growth or decline. And what we see is international growing. These are nominal dollars, almost 10%. Environment animals 3.6%. And the others are either all essentially flat or declining. And so you can see that even in a year where giving grew in nominal dollars and fell in inflation adjusted dollars, you see very disparate effects depending on the subsector. Next slide, please. And I just mentioned this a minute ago. If you look at these trends over time, international and environment and animals, you see growing so much more dramatically, so rapidly since we started tracking them in 1987. Next slide, please. Again, this helps you to visualize that for human services, education, public society benefit, and foundations, that although there was a decline last year, that most of those had set records the prior year. Now, I mentioned earlier that giving to religion was below 30% for the first time. Over the last 5 years, it's averaged 31%. And you can see on the slide that 40 years ago, it was almost 55% of total giving was going to religion. So you can see a very dramatic drop in market share, especially in the last decade or two. Okay, next slide, please. I want to spend a little bit of time talking about some things that we measure in a very precise manner, but are really at the end of the day reflecting our social values and norms. So if you look at total giving as a percentage of gross domestic product, GDP, and inflation adjusted dollars, we can see that, in the late 70s, early 80s, that it was 1.6 to 1.7, 1.8%. And for the last, most of the last decade or two, it's been more around 2% with a dip during the Great Recession. And what we see today is, it's at 2.1% the last couple of years. What we know is that if you scaled this up in an Excel spreadsheet and did this from 0 to 100, this would look like a flat line at around 2%. Now, is this too much? Is that too little? Again, this is a value choice. Keep in mind that gross domestic product is a very big number. And so to move that needle on this has historically seemingly been impossible for us as a society. On the other hand, I did a calculation that if each of us reallocated $5 a day, each household, then household giving, which is the largest source of giving, would double overnight. So it's not an impossible task. It's not something that, I accept that some households could not reallocate $5 a day, but many could reallocate $5 or more and not feel it in their household budget. So, is this reflective of, larger factors? Absolutely. But at the end of the day, this is primarily a value choice. Next slide, please. This is looking at individual giving as a percentage of disposable or after-tax personal income. And again, this has been fairly, stagnant at around 2%. Keep in mind that this includes a share of households ranging from 1/3 to 40% of households that don't give anything in any given year. So those numbers might be more like 3 or 3.5% for the donor households, but including those zeros, it's been pretty close to 2%. Again, reflecting a choice that we each make on a separate basis, but collectively it's been 2%. Next slide, please. Similarly, corporate giving as a percentage of corporate pre-tax profits has been very flat at just under 1% for the last decade or two. It has popped up and down, and somewhat based on the business cycle and changes in tax policy, but it is primarily related to corporate profitability and GDP, and we've seen nice growth in that the last couple of years. Okay, next slide, please. I know this is the number of 501c3s for the last decade or so, and we see this drop in the number of charities in the middle, 2011, 12, 13. And that essentially happened because the IRS deduped their database. So they sent everybody who had not filed an IRS 990 informational tax return for a number of years. They sent those to all those charities, and if they didn't respond to several prompts, then they were delisted, so to speak. And so we saw that drop from 2010 to 2011. We didn't really lose 200,000 nonprofits. Probably most of those were not operating or operating at a meaningful level before that, and they hadn't been delisted before that. But now, since that has kind of settled down, we've seen a growth back to almost 1.3 million charities. This, keep in mind that this is not including very many of the congregational charities, because they are not required by law to file an IRS 990 informational tax return. So the number of total charities is probably 300 or 400,000 more than that. And I put this up here just to help us emphasize the point that there are so many charities, and they all do different things and in different ways and serve different segments of our society. But they're also competing in some level or another with the government, with for-profit entities perhaps, and with each other. And so I know for many of you as fundraisers, you feel that competition in a very acute, real manner. And I just think this slide is a good reminder of that. Next slide, please. I think one of the things that as fundraisers and CEOs and board members and donors, we need to understand the new trends in giving. Crowdsourcing is real, and now it's important to note we don't include things like GoFundMe in our estimates of total giving. Now, those gifts may be altruistic gifts and philanthropically motivated, but they're not a gift to a 501c3, and so they're not a tax deductible gift, so we don't capture those in our estimates. And I think it's important to understand and recognize and talk to your donors about how the current policy climate may affect them, and embrace new financial tools. So if your donor says, I'm creating a DAF and I'm going to give to you every other year or every third or fourth or fifth year, and here's what I'm doing and why, that's fine. It may be your best opportunity to get the same gift on an average basis or even a larger gift. But if they're bundling their gifts to you directly, it'd be helpful to know about that so that you're not planning on a big increase or a big decrease based on a year-to-year shift. And I think data from Giving USA and other resources help you to be responsive to the shifting landscape of philanthropy, so that when things change, you can anticipate what those changes may do in terms of a change in public policy and a change on philanthropy, or a change in values, such as those who are not affiliated with a congregation, how those may be affecting philanthropic giving as well. Okay, well, I think we're ready to open it up for questions.
Great. Okay, Patrick, well, I have a few questions, and I want to preface this first one. Well, first I want to tell everybody who wrote and asked the question, will they get the slides and the recording? You will. So don't worry about it. You don't have to ask again. I understand some of you came in a little late. But I want to ask you about one trend which you didn't really cover, because it really isn't a part of Giving USA in a way. But you did write an important article about it last year, and it came directly out of our discussion last year, after which I asked you, can you definitively say that smaller donations, the number of smaller donations are decreasing, and that there's a larger and larger amount of the total giving picture that's made up of larger, more mega donations? And you wrote an article for us confirming that. And I want to take a moment to just ask you to talk about that. And I want also at the same time to ask those who are participating to think about what questions for you emerge out of this presentation that you've just heard. Because I feel like if we don't keep pushing at, oh, you told me this, but I don't know that, and that's really what's important, then these presentations, aren't going to kind of advance us very much. So as Patrick's answering my question, maybe you can think about, well, what are the next set of questions that we need to have answered, or what's kind of hidden for us, or can you confirm something or another? So going back to the original question, Patrick, can you talk a little bit about the trend of small to large donations and what you think that means to local nonprofits, how it relates to what are the dynamics that nonprofits need to be aware of in the individual giving sphere?
Sure, Ruth. Well, that was a great question then, and it's still a great question now. And I think it's important to understand both, that these two forces are affecting lots of charities, and depending on your donor base, they're going to affect your charity differently. So, if you look at, on the one hand, small and medium-sized donors, what we see in our data from our philanthropy panel study is that they are becoming less likely to give at all, but of those who are giving, they're still giving similar amounts, but that they're less likely to be giving anything at all. So they're making some tough budgetary choices in many cases. And then on the other hand, we see a fair amount of evidence that the gifts from larger donors are playing a larger and larger role in philanthropy. So for example, if you look at the growth in DAFs, you don't have to be a billionaire or a millionaire to have a DAF account, but someone who's at the median household income is probably unlikely to have a DAF and have that philanthropy organized, nor are they likely to have a private family foundation. And what we see is, if you look at the growth in foundation grant making over the last 40 years, that's grown at about 5 times the rate of the growth of household giving. So that's clearly, on an upward trajectory in terms of its growth rates and therefore its market share. Similarly, if you look at IRS data for itemized givers, total itemized giving versus itemized givers who earn $1 million or more, and $1 million or more is a small share of households, but 40 years ago, 30 years ago, they accounted for like 10%, less than 10% of total itemized giving. The most recent year for which we have data, it was almost 30%. So you can see, these are, the millionaires in income, not just in net worth, but in income, their effect on total giving and total household giving has grown fairly dramatically. So you see this foundation effect, structured philanthropy, you see the giving by high income households, and then you see the growth in DAFs, all evidence of the growth in giving by the high end. Conversely, we see in our household data, at the micro level, that those who are at the median household income or below are less likely to be giving at all.
Well, I actually have a couple of follow-up questions that are coming in from the participants, which I think are really good. One of them is, do you feel like the effect of the standard deduction, do you think there was any effect on middle level givers? Did it make that trend worse? And another participant is asking, you made a recommendation in your article that we actually posted again this morning as our feature for the universal charitable deduction. Can you talk a little bit about those two things?
Sure, Ruth. So, we did some research that was commissioned by an independent sector last year, and we estimated that, holding constant changes in GDP, changes in personal income, just looking at what was the pure tax effects of, we didn't have the final tax bill available then, but it was pretty close to that. And we estimated that household giving would go down by 4.6%, plus or minus, right? And what we saw in actuality was that it went down by 3.4%. And some people have written, well, we were way off, or we really got that wrong. But in fact, I would argue we're pretty damn accurate, because we were saying that was the pure tax effect, and income went up 5%, GDP went up 5%, and normally you would expect giving to go up in that 5% range with that, plus or minus, with that kind of growth in income and GDP. And the fact that, household giving went down almost 3.5% suggests that the doubling of the standard deduction certainly had a pretty significant effect. Now, again, people don't give just because of the tax incentives per se, but it is an incentive to give, and it's an incentive to give more. And for people who are trying to balance their budgets, if they have to make some tough decisions on the margin, they may be affected by that. And we know that when people move from being itemizers to non-itemizers, that their giving tends to go down by between $100 and $150. But if you control for differences in income, those effects are even larger. It tends to be more like $300. So, and I think it's important to recognize that many people who make a fair amount of income would be non-itemizers in this new tax bill. So it's not just low income or even middle income households. This spreads up until the very high reaches of the income distribution.
I really, I have to say, I appreciate our participants because they are very smart. So here's a question which I think is related, which is, what's the performance of workplace giving? And you and I have talked about this, Patrick, as, somehow in this dynamic of, a smaller engagement in giving by low and middle income households, it figures in workplace giving. And we've certainly seen a trend in a lot of the workplace giving campaigns, particularly in the CFC, but I think also in a lot of United Ways. So I guess the question is, with that whole dynamic, what do you think? I would say that there's probably a pretty important charge for nonprofits to reconnect with donors at this point.
Right.
That in fact, if we are seeing a downturn in workplace giving, and we are seeing lesser people of low and middle income giving at all, that's a pretty clear call for nonprofits to reconnect with their individual donors. Would you agree with that?
No, I think, yeah, sure. I think you're right on the mark. So if you look at the federal government's, employee workplace giving campaign, obviously that plummeted, and it's hard to know how much of that was due to the government being shut down for part of that time at a critical time, and how much of that is a change in values or a change that's going to be long lasting. But what we've seen is United Way is still raising a lot of money collectively, right? I mean, it's not like United Way has gone from a huge number to zero, but that they are losing some market share gradually over time. And one of the things that's happening is that many new small businesses are not engaging with United Way. A lot of the old line manufacturing organizations that did for many decades, their labor force is smaller, and it's not just because jobs have been shipped abroad, but it's there's a lot more capital intensivity. There's a lot more robotics doing those types of jobs, which is mostly good for the economy in terms of a lot of those jobs were very dangerous, risky jobs for employees, but it's bad for United Way in terms of if those workers are now being employed in organizations that don't have a United Way campaign, United Way is probably unable or unlikely to be able to reach out to them from a fundraising perspective. So therefore, the charities that might have gotten grants from United Ways they're going to have to do more fundraising on their own, and they're going to have to be more self-reliant rather than relying as heavily on United Ways.
Right. There's another question here that's somewhat related, and then I'm going to get off of individual giving. But I do think it's a critically important issue this year that people do come to terms with their need to reconnect. But one of the participants asked, is there any indication, and I think that you'll be able to answer this one, Patrick, from other research you've done, is there any indication that place-based giving is a good way to reconnect with donors?
Yeah, so place-based giving has been going on forever. We just didn't call it that, right? I think a lot of our research shows that the vast majority of giving, both from households but also from foundations and corporations, remains within your metro area, and if not your state, or a nearby area. Now, for some individuals, their alma mater is in a different state, and so there's transfers that way across the state borders. And some people care about the environment or care about international affairs, and their giving may not be local as a result of that. And although they can do environmental giving locally as well. So I think you see some of these changes affecting these dynamics, but there's a huge share of total giving, especially by individuals, that is place-based and quite localized.
Yeah. Yeah, I think the research is really clear that, that those are the tendencies. We got any number of questions, as you can imagine, about DAFs, donor advised funds, and this was predictable. Everybody's very curious about how donor advised funds exactly are affecting what we're looking at, and how we're experiencing the flow of donations. So can you talk about how that affects other realms? One of the questions that we got from a community foundation is, why are we seeing donations to foundations going down when we know that donations to donor advised funds are moving along at a pretty fast clip?
Yeah, so I think that's a really fair question, and important to parse that out. So two factors working in an opposite direction on that specific point. So at the end of 2017, so the tax bill was passed in mid-December of 2017. So people had about 2 weeks to do anything about that that year. So I was on a panel with somebody who works for one of the commercial DAF firms, and she said that she and her staff were working 24/7 for the last 2 weeks of December 2017, as people either created new DAF accounts or were shifting funds from their household checking accounts into existing DAF accounts. And many of them did this not knowing necessarily what the impact of the tax bill would be on them, or in anticipation that they may not be able to be an itemizer, and they wanted to shift their giving by a week or two. And you have to be able to do that cash flow wise and anticipate it. But what we saw was a bump up in giving to DAFs in 2017. I think as people have the experience of what the tax bill, how that plays out on them personally, I think we'll see some people bundling their gifts through DAFs, or doing it directly themselves, giving more in one year and less in another year to their local charities. And as donors who do that, we would hope that they would communicate with their recipient organizations that that's what they're doing, and that they haven't doubled their annual gift, or they haven't tripled their annual gift, and then the next year they give nothing. That in fact they're doing this bundling for tax purposes. At the same time, the stock market has grown for the last decade, and so the total foundation grant making has grown because of the cumulative effect of the stock market, not because of the shift in the tax policies. So I think that it's one of the things, I'm not on social media, but I've heard that phrase, it's complicated. And this year is complicated. And the reason is because you have all these different factors, some moving to stimulate giving, some moving in a direction that would have a contraction effect on giving.
Right. And in back of that are some macro trends that we can see have been going on for a number of years. And it feels to me like those are things that people really need to be paying attention to. So in the immediate, we know there's a lot going on. We're not quite sure how the downturn in the stock market last year affected kind of what's being given this year or any of that. We have some sense, but not absolutely, but multi-year trends are more critical. So can you talk a little bit about, just refresh what those multi-year trends are for people?
Sure, absolutely. So what our research has shown is, looking at the data for Giving USA, is that variation in the stock market within any given year is not predictive of giving by households in that year. But if you look at year end to year end, that's a very powerful predictor of changes in household giving. So the growth in the S&P 500, that's the market index that we use because it just has, it's a long public record, and you know, anybody can get access to that. So we use that to, and it's more stable than the Dow and so on in some ways, because there's more firms in it. You know, we use that as a proxy for wealth, but obviously when people have more income and more wealth, they're more likely to give, and they give larger amounts. And so growth in income, growth in GDP, growth in the stock market are all predictive of good things for philanthropy.
Right. Okay, so there's some kind of general questions about some particular sectors here, and I want to ask you what I think are kind of the ones we've been asked most often. And one of them is about corporate giving. And it's just a question about what does that include, and this is something I always ask you about, right?
Right.
Which is, how much of that is cash? How much of that is in kind? Do we actually have a sense of that? And how does the proportion of pre-tax, what's the proportion of giving to pre-tax profits?
Yeah.
Because
so
I know that's been it's kind of declined over time.
Yeah, it's declined a little bit. So if you look at total corporate giving as a percentage of pre-tax corporate profits, it's been less. It's averaged less than 1% for the last 40 years. For the last few years, it's been more in the 0.7, 0.8% range. So, you know, it's down slightly from 0.9.
Even while those profits, I just want to say this, have massively increased, right?
Right. Right.
Okay.
So, I mean, so
Patrick doesn't like to say those kinds of things, but
well, right. So, but when you're looking at, it's like GDP. GDP has grown a lot, and for total giving to keep up as a share of GDP, it has to grow fairly rapidly. And similarly for corporate profits, the faster they're growing, the more corporate giving has to grow just to keep pace with that. One of the things we see with corporate giving is that it tends to, most major corporations today, are budgeting a share of their profits for the next year. So if their corporate profits grew last year, their corporate giving is going to grow this year. But if corporate profits grew more this year, then as a share of corporate profits, total corporate giving, it may go down, right? So they'd have to budget an even larger share for that to keep up. And I'm
which
not saying
they should be doing, right?
I'm not saying they shouldn't, but I'm just saying mathematically there's a lag effect, right? I think in terms of the in-kind versus cash, we know that for some types of corporations, the pharma, there's a lot of in-kind giving. There's still some cash giving. For software companies, there's a lot of in-kind product giving. For food companies, a lot of in-kind giving. We know that corporations are tending to decentralize their decision-making about corporate giving. So the corporate headquarters still gives a disproportionate share, but a lot of times, wherever they have a plant or distribution center or retail outlet, there is some local decision-making about some of the corporate giving at each of those sites.
So can you Can you just talk a little bit about the 2, 3, 4 things that you think nonprofits generally should be doing differently this year? I know you don't like this. I know it.
Yeah, that's harder, but so I think one of the things that is just imperative is that um, even though total giving and household giving went down, adjusted for inflation, um, it is not time to panic. It is not time to say, the sky is falling. It's not time to say, call off the capital campaign. Um, you know, Again, it declined, but it declined from a record year, and it's the second highest year. So, um, on the other hand, it's important to recognize that those tax price effects, that we would say as an economist, the incentives to give are permanently changed. So, those non-itemizers, some of them will switch from itemizer to non-itemizer status year to year, depending on, their contingent income or their commission income, or if they have a second job and stuff like that. But for the most part, many people who have been itemizers for decades will now be non-itemizers for decades, and unless there's a policy shift. One of the things you talked about earlier was the universal charitable deduction. If we had the universal charitable deduction for all non-itemizers, that becomes even more important with the growth in the number of non-itemizers. Our estimates for independent sectors suggest that just implementing something like a universal charitable deduction would more than offset the decline in giving from households. Obviously it would come at a loss of some treasury revenue, and so there's political considerations on that. But at a time when most people don't seem to be paying attention to deficits, I'm not sure that that is as big a deal as it might have been in some other years. Similarly, we did some new research that suggests a 25% tax credit for charitable contributions would be the most stimulative for household giving for non-itemizers. And I would argue it would be the most equitable, because then regardless of your income level, you would still get the same dollar deduction. So if you're in the top income tax bracket and I'm in the bottom one, we both give $1,000, we would both get a $250 tax credit. And so that would be a more progressive way of creating incentive to stimulate giving without having unequal effects based on income of the households. That has the largest treasury loss, though, the tax credit. So, the politics of that become more complicated on both sides of the ledger.
Right. Well, thank you so much, Patrick. This has been, as usual, very thought-provoking, and I do want to ask the participants to think about what are the questions that you really want answered. I'm always I'll call Patrick up and say, so what do you say about this one? And we'll see if we can get some answers even in the interim between Giving USA reports about what exactly is going on. I do want to say one other thing, and it just comes out of a conversation that I had yesterday with a bunch of people from Fidelity Charitable who were bemoaning the fact that nonprofits still think that donor advised funds are some kind of mysterious being. I think most donors from donor advised funds are clear about who they are as they're giving, and so treating them as donors, as individual donors, is the appropriate way to go. So you're essentially just interacting with individual donors. There isn't, I probably don't need to say this to most of you, but there is nothing so mysterious about gifts that are coming from a donor advised fund. And nothing so mysterious about how you have to go about getting those gifts. It really has everything still to do with the relationships that you have.
Right.
So, Patrick, anything you want to send people off with?
Well, one of the dictums of philanthropy and fundraising is that people don't give if they're not asked. And so I think it's imperative that as board members, as CEOs, as CDOs, and frontline fundraisers, that you continue to go out there, be better informed, use the data to inform your strategies, but to keep asking. We saw this decline this year in household giving and total giving and flat line and bequest giving, but I would absolutely say this is not the right time to dismantle your development office, not the time to stop looking for major gifts or for planned gifts at all.
Right. I'm sorry, Patrick, just one last question, because people are saying, but you didn't include what was in, you didn't say how much of corporate giving is in kind. So could you please say that?
Yeah, well, I wasn't purposefully avoiding that, but that's not part of Giving USA. And so we don't update that number. I think Conference Board and CECP update that regularly in their survey research. My recollection, and that's, so don't hold me to this because it's, it's a recollection, not something I've looked at recently, is that it was around, the in-kind giving was around 40%. But I would encourage you to look at CECP and Conference Board for more definitive data, because what we get from the IRS is total corporate giving, which would include the cash and in-kind.
Right. Okay, well, thank you so much, Patrick, and thank you so much, everybody who attended today. And we will be back next year with an update on all of what this landscape looks like. In the meantime, I really want to encourage you to keep in touch with us with all of your questions, so that we know what it is that you need answered about the environment that you're looking at. So thank you very much, Patrick, and thanks to Giving USA for its great work from year to year.
Thank you, Ruth. My pleasure.
See you later.